Let me tell you a lie you've probably believed your entire life. You are a rational investor. You make decisions based on logic. You analyze data, you weigh risk and reward. You buy low, you sell high. At least that's the story. Traditional finance, the kind built on theories like the efficient market hypothesis, assumes we're calm, calculating machines, that when numbers are placed in front of us, we process them objectively and act in our own best interest. But here's the problem. You are not a spreadsheet. You are a 200,000-year-old survival machine running ancient software inside a modern financial system. Your brain was built to escape predators, to react instantly to danger, to follow the tribe when survival depended on it. That wiring is incredible if you're running from a bear. It's disastrous when you're staring at a bear market. Because the moment your portfolio drops 20%, your brain doesn't whisper, "This is temporary volatility consistent with historical drawdowns." It screams, "Threat." Heart rate up, stress hormones spike, urgency, panic, action. And here's where it gets expensive. Psychologists call it the 2x rule. We feel the pain of a loss roughly twice as intensely as we feel the joy of an equivalent gain. If making $10,000 feels good, losing $10,000 feels devastating. Not equal, not balanced, twice as powerful. That asymmetry quietly controls your decisions. It's why you check your portfolio more when it's red. Why bad news feels heavier than good news. Why you feel relief selling after a drop, even if it locks in the loss. Your brain isn't broken. It's just optimized for survival, not compounding returns. And this mismatch between ancient wiring and modern markets is where behavioral finance begins. Because the biggest threat to your wealth isn't inflation, it isn't taxes, it isn't even the next recession. It's the 6 inches between your ears. And until you understand how your brain quietly manipulates your money, you will keep paying tuition to the market. Not because you're unintelligent, but because you're human. Let's start with a bias almost nobody thinks they have. Overconfidence. If I asked you right now, do you think you're above average at investing? Statistically, most of you would say yes. That's mathematically impossible. And yet study after study shows investors consistently overestimate their skill, their knowledge, and their ability to predict outcomes. We believe we can time the market. We believe we can spot the next breakout stock. We believe we can see what others don't. But here's the uncomfortable truth. The vast majority of active traders underperform simple index funds over long periods of time. Not because they're stupid, because they're human. Overconfidence tricks you into thinking more action equals more control. So you trade more. You rotate positions, you chase trends, you react to headlines, you optimize. But every trade has friction. Transaction costs, bid-ask spreads, taxes, slippage, emotional energy. And those tiny leaks compound in the wrong direction. There's a famous pattern researchers have found. The investors who trade the most often earn the lowest returns. Read that again. The people most confident in their skill tend to do the worst. Why? Because overconfidence reduces caution. It shrinks perceived risk. It convinces you that your recent win wasn't luck, it was talent. You pick one good stock and suddenly you feel like you've cracked the code. But markets are probabilistic, not personal. A win doesn't mean you're skilled. A loss doesn't mean you're cursed. Yet overconfidence builds fast, especially in bull markets. When everything is going up, it's easy to believe you're a genius until the tide goes out, and suddenly that high conviction play drops 40%. Here's the twist. Overconfidence doesn't feel reckless. It feels intelligent. It feels like research. It feels like initiative. It feels proactive. But sometimes the smartest move is restraint, because the market doesn't reward activity. It rewards discipline. And your brain, it loves activity, which sets the stage for the second villain, the one that makes smart people do unbelievably irrational things. Let me ask you something honestly. Have you ever bought something not because you researched it deeply, but because everyone else was making money? Be honest. That feeling has a name. FOMO. Fear of missing out. And it's one of the most powerful forces in financial markets. Here's what's wild. Herd behavior isn't stupidity, it's evolution. Thousands of years ago, if everyone in your tribe suddenly started running, you didn't pause to analyze, you ran. Because if the group saw danger and you ignored it, you didn't survive long enough to pass on your independent thinking genes. Following the crowd kept you alive. But in markets, following the crowd often means buying at the top. When an asset is hot, your brain interprets rising prices as social proof. If everyone is buying, it must be safe. But rising prices often means rising risk. Look at financial history. In 1929, before the crash that triggered the Great Depression, taxi drivers were giving stock tips. In the late 1990s, during the dot-com boom, companies added .com to their names and their stock prices doubled overnight. In 2021, during the GameStop frenzy, millions piled into a trade not because of cash flow analysis, but because it was going viral. Even professionals get caught in what Charles Mackay called extraordinary popular delusions and the madness of crowds. Smart people, educated people, experienced people. Why? Because social validation feels like safety. When everyone around you is winning, sitting out feels painful. When screenshots of gains flood social media, your brain doesn't calculate valuation ratios, it calculates status, and status feels urgent. But here's the trap. By the time something feels obvious, most of the upside is gone. Herding leads to buying high. Then, when the trend reverses, the same herd runs the other direction, selling low. The crowd amplifies both greed and fear. And if you don't recognize that pull, you'll mistake collective emotion for opportunity. The market doesn't care what's trending. It cares about price versus value. In your brain, it cares about belonging. That tension between independent thinking and social comfort is expensive. But we're not done. Because sometimes the costliest decisions aren't about what you buy, they're about what you refuse to let go of. Now we get to one of the most painful biases of all, anchoring. This is where your brain latches onto a reference point, usually the price you paid, and treats it like sacred truth. You buy a stock at $100. It drops to $65. Logically, the only question that matters is, given what I know today, is this still the best place for my money? But that's not what your brain asks. Your brain says, I'll sell when it's back to $100. Why $100? Because that's your anchor. That's the number your brain stamped as fair. Even if the company's fundamentals have changed. Even if better opportunities exist. Even if your thesis is broken. You're not evaluating the future, you're negotiating with the past. And then we layer on something even more dangerous, sunk cost fallacy. You've already invested time researching, you've already told friends about the pick, you've already watched hours of interviews defending it, you've already committed. So selling feels like admitting failure. And your brain hates admitting failure. But here's the reality. The market does not care what you paid. It does not care how long you've held. It does not care how much effort you invested. Every dollar in your portfolio is equal. It doesn't remember its history, but you do. That emotional attachment keeps people holding losing positions far longer than they should. And here's the irony. We do the opposite with winners. We sell them too early to lock in gains because we fear losing what we've made. So we cut flowers and water weeds. We hold losers because of pride. We sell winners because of fear. That's not strategy. That's psychology. Anchoring makes the past feel relevant. Sunk costs make quitting feel painful. But investing isn't about defending your ego. It's about allocating capital efficiently. And until you separate your identity from your investments, you'll keep protecting your pride instead of your portfolio. But there's one more subtle bias that quietly shapes how you treat money, and it's so common you probably don't even notice it. Now let's talk about a bias that feels harmless, but quietly distorts everything. Mental accounting. This is where your brain treats money differently depending on where it came from. Logically, money is money. A dollar is a dollar. But psychologically, not even close. You get a $5,000 tax refund. It feels like a bonus. Free money. Extra. So what happens? You spend it faster, you take more risk with it, you justify splurges you wouldn't normally make. But if that same $5,000 came from your paycheck, money you worked 40 hours for, you'd protect it differently. Why? Because your brain puts money into emotional buckets. Salary bucket, bonus bucket, dividend bucket, gambling win bucket, inheritance bucket. Each one carries a different emotional weight. Here's how this gets expensive. Investors often treat dividends like income they can freely spend, even though it's technically just part of their total return. Or they take bigger risks with profits. I'm just playing with house money. No, you're not. There is no house. There's just your net worth. When you mentally separate money, you stop evaluating it objectively. You might keep a low-performing stock just because it pays dividends, even if the total return is underwhelming. Or you might gamble gains from a good year because it doesn't feel like your real money. But compounding doesn't care about your emotional labels. It only cares about consistency. Mental accounting also shows up in debt. Someone might carry high-interest credit card debt while keeping cash in a savings account for safety. Emotionally, that savings account feels secure. Mathematically, it's inefficient. Your brain prefers neat categories, but wealth building requires integration. Every dollar should be deployed based on opportunity cost, not emotional origin. And here's the bigger theme emerging. Overconfidence makes you act too much. Herd mentality makes you follow too much. Anchoring makes you hold too long. Mental accounting makes you misallocate. Individually, these biases seem manageable. Together, they quietly drain returns year after year. And this is where the real cost shows up. Not in one dramatic mistake, but in thousands of small emotional decisions compounded over time. Now let's zoom out, because these biases aren't just interesting psychological quirks. They cost real money. Overconfidence leads to overtrading. Every time you jump in and out of positions, you're paying spreads, commissions, taxes, even if you don't see them directly. And the more you trade, the more those invisible frictions compound. There's a brutal pattern researchers have documented for decades. The investors who trade the most earn the least, not because markets are unfair, because activity feels productive, even when it's destructive. Then comes panic selling. Markets drop 15%, 20%, 30%. Your fight or flight system activates. Remember, your brain interprets volatility as danger, so you sell. You go to cash. You tell yourself you'll buy back in when things feel safer, but markets recover before they feel safe. By the time headlines turn positive again, prices are already higher. Temporary drawdowns become permanent losses, not because the market failed you, but because fear overruled your plan. And this isn't new. From the 1929 crash to the dot-com collapse in the early 2000s to the 2008 financial crisis, even experienced investors sold at the bottom. History doesn't just repeat, it rhymes with human emotion. Then there's home bias. This one's subtle. We prefer investing in what feels familiar. Companies in our country, brands we recognize, markets we hear about daily. It feels safer. But the world is bigger than your comfort zone. By ignoring global diversification, you limit exposure to innovation and growth happening elsewhere. Comfort replaces optimization. Add it all together and here's what you get. Too much trading, poor timing, under-diversification, emotional decision-making. And the damage doesn't show up instantly. It shows up in opportunity cost, in the compounding you never see, in the extra percentage points quietly shaved off your long-term returns. 1% per year doesn't sound dramatic. Over 30 years, it's massive. Your brain doesn't destroy your wealth in one catastrophic move. It erodes it slowly, quietly, convincingly. Which raises the obvious question. If we know our brains are wired this way, how do we protect ourselves from ourselves? All right. We've diagnosed the problem. Now let's talk about the solution. Because here's the truth most people don't want to hear. Awareness alone isn't enough. Knowing about overconfidence doesn't stop you from feeling confident. Understanding FOMO doesn't eliminate it. Recognizing loss aversion doesn't make losses hurt less. You can't delete 200,000 years of evolution with a YouTube video. So instead of trying to become emotionless, you build systems. Rule number 1. Respond, don't react. When markets drop and your stomach tightens, pause. Literally, pause. Ask yourself one question. Has my long-term plan changed? Not, does this feel scary? Not, what is everyone else doing? Not, what are the headlines saying? Just, has the underlying reason I invested changed? If the answer is no, your action probably shouldn't change either. This small gap between stimulus and response is powerful because emotion demands urgency. Strategy demands patience. Rule number 2. Automate as much as possible. Set automatic investments so you buy whether the market feels good or terrible. Use automatic rebalancing so you don't have to decide when to trim winners or add to losers. The system does it for you. Some investors even use predefined rules for exiting positions, not because they're robotic, but because they understand they're human. The goal isn't perfection, it's protection. Rule number 3. Write it down. Create a written investment plan. Why you're investing, your time horizon, your asset allocation, under what conditions you would actually sell. When everything is calm, your rational brain is in charge. Write your rules then, because during volatility, your emotional brain will try to renegotiate. And here's a powerful addition. Keep a decision journal. Before you buy or sell, write down, what am I feeling? What do I expect to happen? What would prove me wrong? Over time, patterns emerge. You'll start seeing where emotion sneaks in. And that self-awareness, combined with structure, is how you reduce behavioral drag. You don't defeat your brain, you design around it. And that brings us to the most important realization of all. Here's the part nobody talks about enough. Successful investing isn't just about knowing valuation metrics. It isn't about predicting interest rates. It isn't about finding the next 10x stock. It's about knowing yourself. Because markets will always fluctuate. There will always be another crash, another bubble, another once-in-a-lifetime opportunity flooding your feed. From the crash of 1929 to the dot-com boom and bust, to 2008, to every speculative frenzy in between. The pattern hasn't changed. Technology evolves, products evolve, speed evolves. Human psychology doesn't. The same fear, the same greed, the same herd behavior. Different decade, same brain. And this is where the edge is, not in being smarter than everyone else, but in being more self-aware. When you understand that losses will hurt twice as much as gains feel good, you stop being surprised by your reactions. When you accept that you will feel FOMO, you build rules before it shows up. When you admit that you'll anchor to prices and defend sunk costs, you prepare exit criteria in advance. When you recognize that you mentally label money differently, you unify your strategy. You stop trying to be perfectly rational, and instead, you become strategically disciplined. Because here's the final truth. The market is not your biggest opponent. You are. But that's good news, because unlike inflation, unlike interest rates, unlike global events, you can work on you. You can build systems. You can automate decisions. You can slow down reactions. You can write rules. You can track emotions. And once you do, you stop paying the behavioral tax. You stop donating returns to impulsive decisions. You stop confusing movement with progress. The most powerful upgrade you can make to your portfolio isn't a new stock. It's self-control. Not suppression. Design. Because wealth isn't built by people who outsmart the market every day. It's built by people who outsmart themselves consistently. And once you understand that, you don't just invest differently, you think differently.